Welcome to this explainer. Today, we're taking some absolutely critical concepts straight out of the CFA Level 1 curriculum, which is kind of like the global gold standard for finance pros, and translating them into a super simple survival guide for your future money. Think of this as your ultimate financial cheat code. Whether you're figuring out what to do with your very first paycheck, or you're just curious about how billionaires actually protect their wealth, this secret sauce is exactly what we're going to break down today. Let's get into it.
To kick things off, I want you to imagine a scenario. Say you've saved up all the cash from your summer jobs, a solid chunk of money, right? And you decide to invest it. But instead of spreading it around, you throw it entirely into one single industry, let's say the aviation industry. You buy up a bunch of airline stocks, sit back, and just cross your fingers. Now, sounds a little bit risky, right?
Section 1. The one basket danger. Okay, so let's dive into exactly why putting all your financial eggs in one single basket is, frankly, a terrifying idea. Sure, it might seem like a quick shortcut to getting rich if that one specific industry booms, but the reality? Way more dangerous. If you dump your entire portfolio, let's pretend it's 10 lakh rupees, into just one massive slice of airline stocks, you are incredibly vulnerable. Think about it. What happens if global fuel prices suddenly spike? Or what if there's an economic recession and people just stop taking vacations? Your entire portfolio could literally collapse overnight just because every single rupee is tied to the exact same risks. In the world of Wall Street, this catastrophic oops actually has a very specific name. It's called concentration risk. Basically, it's the danger of having way too much exposure to one single investment or sector. When you concentrate your money like that, a poor performance in that one area doesn't just put a tiny dent in your portfolio, it severely damages your entire net worth. Section 2. Meet your hero. Diversification. But hey, don't panic. You absolutely do not have to leave your money at the mercy of concentration risk, because we've got a hero ready to rescue your money, and its name is diversification. This is literally one of the most important concepts in the entire CFA curriculum, and the basic idea is incredibly simple but super powerful. Instead of one giant risky chunk of airline stocks, imagine splitting your money up into 5 balanced slices. You've got 20% in banking, 20% in IT, 20% in pharma, 25% in super safe government bonds, and 15% in a gold ETF. Now, if the banking sector takes a hit, it's totally fine, because pharma or gold might rise, and those bonds, they're going to remain completely stable to catch you. Your total portfolio risk becomes much, much lower.
So, why does this work so well? Well, different assets act kind of like different elemental shields in a video game. They protect you based on whatever economic weather hits. If the boss attacking you is inflation, your gold shield absorbs the hit. If it's falling interest rates, bonds are your absolute best defense. An economic boom, equities are going to charge forward. In a pandemic? Well, that's when pharma and technology really step up. Because all assets don't move together at the same time, combining them totally neutralizes the chaos.
The secret superpower behind all of this is something called low correlation. In CFA terms, correlation just measures how two assets move together. A +1 means they move together perfectly. Like if one crashes, the other crashes right along with it. And trust me, you do not want that. The greatest diversification benefit happens when you find assets with low or even negative correlation. That basically just means finding investments that don't all crash at the exact same time. When stocks fall, maybe gold rises. They move in opposite directions, perfectly offsetting your losses.
Section 3. Understanding investment risks.
Okay, this brings us to the 2 main bosses of investment risk that the CFA curriculum outlines. Understanding these 2 is absolutely vital for protecting your future wealth. First up is unsystematic risk. This is company-specific risk. Think of things like a single company's management committing fraud, or maybe a specific factory shutting down. The good news here? You can completely defeat unsystematic risk through diversification. But then there's systematic risk. This is the unavoidable market weather, stuff like global recessions, inflation, or war. This affects the entire system, and no matter how much you diversify, you cannot eliminate systematic risk entirely.
So the crucial point is knowing the math behind reducing that unsystematic risk. You really don't need to own thousands of companies. Spreading your money across just 1 to 5 stocks drops your risk massively. Going from 5 to 15 gives a significant reduction. 15 to 30 offers a moderate reduction, but after 30 stocks, adding more gives you a very, very small additional benefit. That's a massive insight. You just need a well-chosen, manageable handful to get the exact protection you need.
Section 4. Real-world crash tests.
All right, we've talked a lot of theory. Let's actually look at what happens to real money when the market actually breaks. Think back to the 2008 financial crisis and the collapse of Lehman Brothers. The U.S. housing market absolutely collapsed. Investors who were entirely concentrated in bank and real estate stocks suffered catastrophic, life-changing losses, literally wiped out. But investors whose portfolios included treasury bonds, gold, and international assets, they experienced much smaller losses. Their diversification acted as a literal life raft.
Fast forward to March 2020. The COVID-19 lockdowns hit. Remember our airline example from the beginning? An investor with a 100% aviation portfolio watched their money collapse instantly due to global travel restrictions. But a diversified investor? Well, while their airline stocks might have dropped, they were rescued by the sudden, massive surge in remote work IT companies, healthcare stocks, and gold. Their overall decline was much smaller, and their recovery was way faster.
Section 5. Building your balanced portfolio.
All right, so you've seen the danger and you've seen the hero in action. How do you actually step up and build this balanced, crisis-proof portfolio for yourself? Well, true diversification isn't just buying 50 different tech stocks. That's just the illusion of safety. Real diversification requires picking entirely different asset classes that serve unique, distinct purposes in your wealth-building journey. You hold equities to get long-term growth. You hold bonds so your portfolio has stability when the stock market shakes. Gold acts as your shield against inflation. Cash gives you liquidity to buy when things are cheap. And real estate gives you long-term appreciation. It's like a sports team. Every single player has a specific job.
If you really want to invest smartly, whether you're aiming for the CFA exams or just trying to grow your own savings, the biggest takeaway is right here. Don't just blindly memorize financial jargon. Understand the underlying logic of why assets behave differently. Relate these concepts to real-world markets. Notice how gold acts during a crisis. Pay attention to how airline stocks react to oil prices, because when you understand the why, you master the game. Because here is the absolute truth of the financial markets. The next market shock, the next recession, or the next unexpected global event isn't a matter of if, but when. And that leaves you to answer one final, very important question. The next time a crisis hits, will your portfolio collapse under concentration risk, or will it adapt, survive, and thrive? Keep learning, stay diversified, and I'll catch you in the next explainer.